Well, thank you very much, and welcome to everyone to today's webcast. Softrax is the leading provider of revenue management solutions to hundreds of companies, many of whom join us on the call today, so welcome to our customers and everyone else. We have well over 1,000 registrants for this webcast, which indicates how much executives want to hear about today's topic from our distinguished speaker, who is John Barnes of Grant Thornton, who is backed by popular demand to make his presentation entitled Update on IFRS, Preparing for Change. This is a follow-up presentation from our webcast that John did with us in May. And as always, our speakers, in this case John, will be available for questions at the conclusion of our prepared remarks. I want to just take you through some housekeeping issues first. I'll spend a few minutes on Softrax and how we fit into today's topic, and then I'll turn it over to John, who will make his presentation as outlined on the screen in front of you. For those of you who are unfamiliar with our webcast format, we do leave some time at the conclusion of John's prepared remarks to answer your questions, and all of this will be done by the top of the hour. To ask a question, please look at your screen now and look for the Ask a Question console, and feel free to enter that question at any time. I'll be reading your questions throughout John's presentation, and I'll ask him at the conclusion of his remarks as many questions as time allows. The most commonly asked question is, can I get a copy of the slides? And the answer is yes, but we do make you work a little bit, about a minute, and at the conclusion of our webcast, you'll be directed to an online survey. We want to make sure that you complete that survey. We listen to those surveys. That's one of the reasons that John is back today, and that will allow you to get a copy of the slides as well as a link to a on-demand recording of this webcast for you to listen to sometime in the future or share it with a colleague. So a little bit about Softrax, and then I'll turn it over to John. Softrax provides revenue management applications, an enterprise software company throughout the U.S. and throughout the world. Hundreds of companies from many different industries use our software to manage their complex billing, revenue recognition, allocation, reporting, and forecasting needs. As you may know, Softrax started by serving the complex revenue needs of the software industry, and we're the clear leader in that market. And as you can see, we have grown to address the complex revenue needs of many other industries as well. Our application suites are designed to meet the challenges that our customers and their CFOs and their financial staffs meet. We have billing and operations applications, including contract management, contract renewal, complex billing, and order management, really unparalleled revenue recognition and expense recognition capability, and analytical applications that are needed to improve visibility to help executives make strategic decisions. And all this functionality can be licensed individually or together, and really provided in two different offerings. The first being a complete billing and revenue management solutions for many different industries where we have deep domain knowledge, and our people do, and our implementation people and our developers do, to make sure that the complexities that these industries encounter are met through our solutions. And secondly, for those companies who have implemented an ERP application, we have the most robust and comprehensive application to complement the ERP applications for revenue recognition, revenue allocation, scheduling, forecasting, and reporting. And our mission is really to help our customers increase their revenue, decrease their cost of doing business, taking out some operational costs that are not needed, while all the while complying with the ever-changing revenue recognition landscape, as will be partially addressed with John today. In the enterprise applications, there really is a missing link, and therefore people are forced to use spreadsheets on critical financial information, especially in revenue information, and many people who are using spreadsheets really do feel that their revenue accuracy is hanging by a thread. The reasons for such widespread manual processes are reflected in many studies, and I would encourage you to go to revenuerecognition.com to see these studies that are really too small on your screen for you to make sense of here. But revenuerecognition.com, in concert with IDC, has provided us and you a lot of information with regard to information about revenue in other areas, and certainly the problems here are that the area of revenue is the most complex to manage due to business models, regulation, obviously, transaction types, and transaction volumes. It's repeatedly noted as the area that's most challenging to establish internal controls. As I mentioned earlier, standard ERP systems are really not designed to manage the complexity of revenue. And getting revenue wrong has huge impact with respect to compliance and the size of the materiality. If there's a restatement, it can be devastating. Studies do find, again, and these studies are on revenuerecognition.com, that more than half of public companies cannot finalize their revenue numbers within their monthly close based on the complexity and volume of their transactions, and many companies are forecasting revenue based on inaccurate data. And the fundamental issue here is that for many industries, and the list of industries is growing, they really can't manage the classic order-to-cash process that their ERP systems or generic financial applications are designed to manage. As early as the contract and order, there needs to be a parallel and integrated process to manage the complexities of revenue. And as John will tell you, in terms of ever-evolving regulation, this gets more and more complex as we go. Unfortunately, we see many companies who do business or are organized, and their systems are organized, as you see on the screen, which lead to many operational problems, profitability issues, cash flow issues, as well as strategic disadvantages. And what we're seeing now, and as we transition to John, we see today that people are dealing with U.S. GAAP and compliance issues, and then tomorrow it's IFRS, and the future continues to evolve. And regardless of what comes at us or our customers, our goal is to provide an underlying revenue management infrastructure that allows people to deal with the changing environment, an ever-changing environment that they have to deal with. So that concludes my introductory remarks. I'll hand it over to John Barnes. John is a partner in the Advisory Services Group in Grant Thornton's Mid-Atlantic practice. He has over 12 years of combined experience in audit, tax, accounting, Sarbanes-Oxley, and internal audit consulting services. John plays a major role with the coordination of the firm's advisory service offerings around IFRS. So we have the right person for the task at hand today. And welcome back, John, and the floor is yours.
Bob, thank you very much, and thank you, everybody, for logging on today. Over the next 45 minutes or so, I'm going to give you a brief background on Grant Thornton, on where we are in IFRS, some process, people, and technology implications, and an approach that you may take as you embark on the conversion from your current accounting processes to IFRS. Grant Thornton. We are the fifth largest global accounting firm. We were founded in 1924, so we're celebrating our 85th anniversary. We have over 50 offices in the U.S. and offices in 112 countries worldwide, and we work with a wide variety of clients and team members, not only within the U.S. but outside the U.S. as well. So, briefly, we're going to cover what IFRS is, the proposed roadmap from the SEC, some brief examples of differences between IFRS and U.S. GAAPs, some overall risk and benefits, and where we currently stand in relation to IFRS. So, IFRS is an abbreviation for International Financial Reporting Standards. These were developed by the International Accounting Standards Board, and the overall objective was to develop one single set of high-quality, understandable, and enforceable standards across the world to provide better liquidity to companies, better comparability across industries, and the like. And what people sometimes don't realize, because there's been a lot of press recently about IFRS, is that this actually started with a movement back in 1967 through the establishment of an international study group up through the International Accounting Standards Committee in 1973 to some memorandums of understanding that were issued in 2002 and 2006. So it has been a long time coming. It is just recently that we are seeing a lot more support and movement due to various factors. In September of 2008, the SEC, under the prior administration, released an IFRS roadmap, and this roadmap, which we'll go over in a slide or two, detailed the project timeline for U.S. companies to move from the traditional U.S. GAAP to IFRS. Some milestones that it's our understanding the SEC looked at as part of putting together the roadmap were overall improvements in accounting standards on an international basis, funding and accountability for the International Accounting Standards Setting Foundation, improved use of XBRL for financial statements, education of training on IFRS in the U.S., limited early use by eligible entities, which is in fact in place now, how the role of the SEC will interact with the International Accounting Standards Board on a go-forward basis, and potential implementation for mandatory use, which now is a good time to go over sort of the proposed roadmap as it exists now. As it exists now, the first time that large accelerated filer companies, and I can define that if this group feels necessary, but that's a common nomenclature to define the largest filers with the SEC. The first date that they would be eligible to use IFRS or be compelled to use IFRS under the current proposed roadmap would be 2014. And over that roadmap, it would be phased in over the next 3 years. So for your year ending December 31st, 2014, it would be your K filed for that year for your largest companies, and then would follow suit for the next 2 years as that trickles down to the smaller companies.
If I can interrupt, John, for 1 second, and I just want to remind our audience how to ask a question. Look at your console and submit at any time. So I thought I'd reward the first question asked, and then I'll let you go for a while. The understanding was that this roadmap was put in place by the former commissioner. What does the current commissioner think of this roadmap?
Well, that's a great question, Bob. And let me go to the next slide, and I'll answer it because it's interesting, because I think as recently as the end of last week, we saw some different comments coming out of the SEC. If you look back over this past year, in January of 2009, Chairwoman Shapiro had said we weren't going to be bound by the existing roadmap that's set out for public comment. Well, just as late as last week, in comments that the chairwoman made at a speech at Georgetown University and comments coming out of the G20 summit and the like, it appears that IFRS is back on the agenda for the fall for the SEC to address. And I think they've received a lot of comments. They're based on what I've read on the speech. I did not attend, but I've read some articles about it. There's been generally support for movement towards one set of common accounting standards, and in addition, the G20 leaders that just met in Pittsburgh are in support of this and have fully made comments to try to move the U.S. along those lines to catch up with the other countries. But some important developments as to why this might have taken place. The SEC just named their chief accountant in August 2009, and there's still continued comment and discussion amongst corporations. Now, just overall, some broad-based differences between IFRS and U.S. GAAP. U.S. GAAP is more rule-based. Anybody who's had the pleasure of reading through the codification and the like knows that there are thousands upon thousands of pages of detailed standards that we can go out and point to, and pretty much gives us a step-by-step guide as to how to account for something. This makes them easier to enforce, but also makes them more likely to be evaded, because companies could possibly structure transactions around those detailed rules. IFRS is trying to take a different approach and be more principles-based. This means there are more choices, they're less specific, there's a lot more professional judgment that gets put in place, and they're harder to evade. It brings a lot more disclosure to the financial statements, so there's a lot more critical thought that the companies have to put forth in their disclosures. Just some differences briefly. Extraordinary items under IFRS are prohibited. Currently under U.S. GAAP, they're permitted. Basis for measurement for PP&E. Under U.S. GAAP, its basis is valued at historical cost. Under IFRS, it can be revalued at a revalued amount or a historical cost. And there's plenty of differences between U.S. GAAP and IFRS that we could spend 8 hours on a webcast discussing. But I would point you towards Grant Thornton's website, and there's approximately a 160-page document that would walk you through these differences between the two bases of accounting at a high level, but that's free for anybody that wants to just go out there and pull it down. We talked about some of the overall benefits and risk. Some of the, I want to touch briefly on the benefits, which is what we're definitely seeing a lot more focus on recently. That increased transparency, increased consistency by companies and across nations. There is a belief that it will increase cross-border capital flows, so it'll make capital allocations more efficient and the most efficient allocation of capital possible. A lot of what we're being asked is, what should companies do now? And I think it's great, based on the prior comments I shared, the SEC is moving forward with this, because I think a lot of companies, obviously in the economy this past year, were trying to save money wherever they could. But a lot of the lessons we've learned from our fellow firms in other countries is those companies that wait the longest amount of time before starting to do an analysis are those that have the most problems and are under the most time constraint. And it's sort of like every other change management project that you might have ever been involved with at your companies. Some things just take time, and the longer runway companies allow themselves, the better. So we're going to go over some things that you might want to consider as you go through a conversion process and start to think about that. And Bob, if there's any questions along those lines, feel free to interject. In terms of internal considerations, what internal resources do you have available to manage the conversion process? Do you have within your company resources that have been through the conversion, maybe located at an international subsidiary? Can those be transferred to the U.S. to share the knowledge? How will the finance department be affected by the change to a new basis of accounting? You have to consider, when you go through a conversion process, you're most likely going to be having to track financial statements on two bases of accounting. If we use the large accelerated filers, for example, the first date that they need to be compliant with IFRS is 2014. But you're going to need to file comparative statements for the prior 2 years as part of that K filing. So you're going to need to be tracking both sets of statements under both sets of standards for a period of time. That's going to put an additional strain on your accounting people, processing, technology. And what are you doing to train not only management but the board to make informed decisions about IFRS? Are you starting to send people to training to learn about IFRS? So some things to consider from an internal basis. Some financial reporting considerations you might want to take into account. what type of analysis does your company want to do to understand where your financial statements will be the most significantly impacted, and how that might change based on the different choices that are available to you under IFRS? What type of information about these changes are you going to need to communicate with your external shareholders? And when do you think this communication will be appropriate to be made? You're also going to want to think about is what your competitors are doing. How comparable are we going to be to them? And how do we want to minimize or maximize the potential impact to our investors? IFRS is going to allow you possibly more choices as to what to do, and this might produce some unintended benefits or consequences, and companies need to be prepared to understand what those might be. Big part of this process is cost considerations. Should you use internal or external resources to manage the conversion process? How are you going to manage both internal and external costs? I've seen different pieces of information about different studies, and all of them conclude that the conversion costs are expected to be heavy on a people and technology front, so that companies can comply with this. And the sooner you get an understanding of what this is going to cost, the more likely that you're going to be able to appropriately budget and control those costs by putting in the appropriate program management structures. IFRS is not only having an impact on financial statements, it's also having an impact on operations. And to that point, how is it in fact impacting compensation arrangements? Will changes in revenue recognition change how commissions are paid? How is this tied into our debt covenants? How will the basis of a change in accounting change those debt covenants? Have we thought about that and started engaging our lenders in discussions? How about customer contracts? How is that going to impact those? And any other transactions that have a significant impact on the financial statements are something you want to start considering. Will the company need to change or update policies, procedures, and IT infrastructure? We're going to explore these later in more detail in this presentation, but the answer is yes, you're going to see significant changes in all these areas. So some short-term benefits for starting now. They would be giving you a better and more full appreciation of the challenges, scope, and potential impact of items. It gives you increased time to consider various accounting options. It gives you time to discuss them with your board, discuss them as a management team. It's going to help you control cost and control the timing of transition, because you're going to allow yourselves more time to plan, and you're going to be able to better contingency plan for things that may come up that you're just not aware of now, but that might pop up in 2 years. Some of the long-term benefits are you're going to be able to possibly get a standardized local and international reporting requirements. It might allow you to consolidate accounting centers. If you're a large multinational company that has distributed accounting centers in Japan, China, Europe, etc., it may allow you to consolidate some of those accounting centers, because if you're working off of one basis of accounting and allowed to file statutory reports under that same basis in all different countries, you might not need such a distributed network. It should give you easier access to foreign capital markets, as you're able to apply for funds in various places. It should give you better comparability and benchmarking to your peers, because everybody will have similar accounting statements. And it will allow you to have a uniform policies of across all your units. Obviously, there's always benefits, but there's always risks. And some of those risks are failure to manage expectations, failure to keep the conversion project focused and moving forward. That's why we recommend that definitely based on your approach, you institute good program management procedures. If you fail to take an enterprise-wide approach and consider all of the different inputs to your accounting processes, that could have a large impact. If you fail to adopt policies and procedures that are consistent with your industry competitors, now there's no way to definitely know that everything is going to be consistent, but you need to consider how similar or dissimilar is our business in fellow companies that we're benchmarked against. And what systems need to change to make sure we capture any differences or any additional information we need to do to make this change. And obviously, there's the risk of missing the deadline to comply with IFRS. And I would say the biggest risk is waiting too long to start to adopt and running out of time. Like I stated earlier, we're going to go over some process implications, some people implications, and some technology implications. We talked about some of the considerations. It doesn't affect just financial statements. It affects your taxes, integration of new processes, the formatting of financial statements, and the like. Some things that you may want to advise your audit committee and board of directors on is they should be obtaining sufficient knowledge on IFRS. We have been talking with our different boards of directors and audit committees about IFRS, giving them presentations, and we'd recommend that you talk to your external auditors and your management team and possibly have those same presentations made. It's good to start to get a baseline understanding of how these accounting changes could have an impact on your financial statements and related internal controls. It's good for them to be aware of IFRS disclosure requirements and how those are going to change, and determine how this transition may impact where financial statements will be required to file for regulatory agencies. In terms of your accounting policies and procedures, this probably goes without saying, but they'll need to be updated. Some of them may stay very similar. Some of them may stay the same. Some of you may already be seeing this as part of the codification process that your financial disclosures and your financial statements need to be updated already. So it's like a lot of things that we do, nothing ever stays completely the same. Staff are going to need to be trained on how to comply with the new policies or procedures. New principles-based hierarchy in the absence of specific rule-based requirements will require people to think and document more of how they reach their conclusions. And policies should be uniform for parent and all subsidiaries. And there really should be no exceptions, even if the business is different in different locales. Internal controls, you may need to change your scoping methodologies to understand things that may have been impacted by your GAAP, by the change to IFRS. You might have to understand the development of new controls for new procedures. You're going to need to review your control documentation, make sure it's complete. You're going to need to develop testing of those controls to meet your requirements under SOX, but so that they reflect what the testing to make sure that you're complying with IFRS. And understand that you're going to be utilizing a whole set of different professional standards. Taxes is something that you may not have thought about how it's going to impact. There could be an impact on pre-tax income on tax implications. IFRS will eliminate LIFO. And I know there's various industry groups out there that are pushing back on the elimination of LIFO, and I don't know where that's going to stand, but right now, as IFRS is written, LIFO would no longer be allowed. Your deferred tax balance calculations are going to change. Transfer pricing methodology may need to change. Contracts. Revenue-based calculations we found fluctuate due to accounting changes. Revenue recognition will be recognized differently for multi-element contracts. We're all used to revenue recognition guidance that goes on for hundreds of pages. I was just looking at the guidance this morning for revenue recognition, and there is certainly not as much guidance as there was in the past under U.S. GAAP. And it's going to be important to use tools like Softrax to make sure that you're appropriately capturing the information and the conclusions you're reaching. As I mentioned before, financial ratios, often used in debt covenants, may fluctuate due to these changes in accounting. And you don't want to get to a point under IFRS where you've blown a debt covenant and you haven't foreseen that and talked to your lenders prior to that situation. Lenders may be more willing to move that or change those covenants due to this change in accounting, but I like to take the approach it's better to plan and have those discussions before it happens and possibly make an amendment to the debt agreement to change the basis of accounting. We talked about some of the risk and benefits before. There's one book of standards for IFRS versus several books for under U.S. GAAP. There are risks. There could be an increase in litigation as there's a lot more ambiguity added by this process from a standpoint. Under the rules, everybody had a specific rule to follow. On the more principle base, there's a lot more critical thinking that needs to be employed by management. The standard body's not located in the U.S. It's not necessarily going to be under U.S. control. Right now on the foundation board, the U.S. has 4 seats, but that is set to change in 2011. I want to touch briefly on some of the people implications that your organization might be experiencing. Really, under IFRS, the entire business community is going to be impacted. Not only is your internal accounting staff, the accounting staff at public accounting firms are going to need to be retrained. Regulatory agencies are going to need to get more up to speed on IFRS, and it is going to have a wide range impact. One of the interesting things that is really just coming to the forefront, and there's been a lot of discussion in the U.S. about it over the past couple of years, is whether there needs to be a big gap for public companies and a little gap for non-public companies. Well, there is a IFRS for small and medium-sized entities, and there are some white papers on the Grant Thornton website that discuss this, but really it allows for some elimination of things that don't necessarily apply to public companies, and there is actually a book of about 230 pages that you can purchase over the internet, which would really give you an understanding of what IFR is for small to medium-sized enterprises. For public companies, there's going to, if you decide to adopt early, IFRS requires a reconciliation to U.S. GAAP in the first year. Mandatory adoption, as I mentioned earlier, will require comparative statements for the 3 years of their statements in accordance with IFRS. Regardless of whether you decide to adopt earlier or wait for mandatory adoption, you should start doing analysis today. All of the universities in the U.S. need to start anticipating the change for IFRS. It's going to require a change of curriculums, a change on training, change set really in the mindset of students studying accounting. There's going to be a lot more critical thinking process that needs to go in to the curriculum, because it's not going to be such a rule-based approach anymore. So there's got to be a lot of justification as to why certain changes are made. Some risk and benefits. There are definitely high costs of retraining people, hiring, transferring staff, but companies get a huge benefit for having a competitive advantage for this change in the business community by having people up to speed earlier. And there's a belief that accountants versed in IFRS will maintain a competitive advantage. IFRS impacts of technology. Most companies worldwide that have already undergone this transition have reported that a majority of their transition costs were in the IT systems. Now, it's interesting to note, and one thing that we've discussed with our clients is to make sure that a discrete budget is put together for IFRS, and it explicitly breaks out what is truly required to comply with IFRS and what are a lot of the nice IT pieces that sometimes get shoved under any sort of change process from an IT perspective. Because this would possibly give an opportunity to certain individuals to maybe go out and acquire the latest and greatest technology in certain areas, but you might not need it to comply with IFRS. So starting earlier definitely gives you a little bit more time to analyze those costs. It could require you to do system upgrades, create new systems, change reporting systems. You're going to have to do dual reporting, as I mentioned earlier, during the transition process. Might require you to change calculations in the system. It might require you to create new reports that come out of your system so that people have the right information to prepare reports. Might require you to change data fields and data requirements. Might require you to change just your general computer control environment. Data retention and data warehouses. Where data is stored and whether it's in the financial reporting system or not may need to change based on its significance to financial reporting. New data requirements may require additional storage. To the extent you can automate controls and processes, whether you're under US GAAP or IFRS, enables you to have a better handle on your control structure. The risk in your technology or system incompatibility, your system might not be compatible with IFRS. You might need to balance your IFRS compliance with other regulations. You're going to need to do dual reporting. Benefits are standard, one consistent package of IFRS accounting standards. Standardized training programs for all users across the organization. It's our belief that the benefits will offset the cost after the initial transition. There are different approaches that you can take to this conversion process. You could take a more strategic approach. This requires planning, but this allows a company to control and drive the process throughout the organization and throughout the timeline. It allows a high level of management input and allows you to take a multi-step approach. And what this will allow you to also do is better provide an understanding of the core team, provide an initial diagnostic of the process, transfer support or knowledge across the organization, and provide better business support. You can also take more of a top side, as we like to refer it, conversion approach. Top side means you take more of an abbreviated time scale. You hire outside advisors to completely control and drive the process. However, you sacrifice. Usually you have a lower level of management involvement, and you usually have multiple simultaneous work streams that are involved, which increases the risk of not being able to transfer all of the knowledge at the end of the project, just because there is going to be a lot more knowledge coming across right at the end from all those different work streams. We really recommend a four-stage approach whenever we work with clients to discuss their conversion needs. We really think the first phase is where companies should be right now in getting a business understanding and initial diagnostic of where things are. And the goals of this first stage are to identify financial statement areas that are likely to be impacted from a change, identify business processes that might be impacted by the financial statement change, and identify financial statement periods that will be impacted from IFRS. Here's just some different websites that are listing of, you can go out and pull out different information on IFRS. I expect there to be a lot of developments over the next few months, and if you'd like to contact myself or any one of these other people within Grant Thornton with questions, please feel free to do so. We'd be happy to discuss anything with you. And Bob, with that, I turn the floor back over to you.
All right, thank you very much, John. Appreciate it. For those people who've asked about access to slides, I gave that instruction at the beginning, and I'll give it at the end here in a few minutes. As many people know, John, one of the things we do very well is handle multi-element agreements and multi-element contracts very well. And in keeping with that spirit, I frequently ask multi-element questions because they all come in and try to group them together as best I can. So got a lot of questions, but we're room for more, so please keep them coming. So to our first multi-element question, John, can non-accelerated users start reporting in IFRS sooner than 2014? What's the effect on private companies, and will they be required to adopt IFRS? And and the third part of that question, is the general intention here that all companies, in fact, including nonprofits, will be required to convert to IFRS sometime in the future? Did you get all that?
I got all that. Let me take the first one. Let me take the 2014 part first. And Bob, if I miss something, just please remind me, and I'll make sure I address it.
Sure.
You may be able to report under IFRS under earlier than 2014. I'm taking this as related to a already existing public company, but really I would expect you to engage that question with your with somebody directly with the SEC, because early adoption was really targeted towards those super large multinational corporations. So they may allow you to adopt earlier, like companies adopting SOX on a phased basis. I haven't seen a big push for companies to adopt sooner rather than later. In relation to private entities adopting IFRS, really your private companies are probably going to be more under IFRS for small and medium-sized entities. And the reason I say that is and this could even apply to very large private companies, this IFRS is actually going to eliminate some of the things that private companies just frankly don't want to deal with and have been dealing with under U.S. GAAP, because there is currently only one GAAP. Now, under IFRS, there would still be one GAAP, but it would allow private companies to make the changes to their accounting policies to not comply with certain things that just don't make any sense for a private company to deal with. And like I said before, there is about a 15-page white paper out on the Grant Thornton website that you can go down and download for free, as well as some other articles on small to medium-sized enterprises. There really hasn't been a lot of talk about not-for-profits in the IFRS space, and really it'll be interesting to see what the standard-setting bodies do outside of the International Accounting Reporting Standards in the U.S. once it becomes effective for public companies. Usually there is a trickle-down effect, but I really can't say for sure what's going to happen towards not-for-profits.
All right, thank you. John, we are seeing customers and prospective customers who are talking about the dual reporting requirements and the conversion process and planning for that now and putting in systems in place for that now. And you alluded to that, can you talk a little bit about, be a little more specific about the conversion process and the dual reporting requirements? We had a few questions about a little more detail on that.
Sure thing. The dual reporting process, let's take 2014 is the first time you would file financial statements under IFRS. Well, just because that is the first time that you would file financial statements under IFRS does not relieve companies from doing comparative statements in their filing. So comparative statements from 2013 and 2012 would need to be done. And if you take that back, you really need an opening balance sheet for 2012, so year-end December 31st, 2011, to appropriately do all of those statements. So that is why we refer to things as dual reporting, because companies are going to want to make sure they're gathering the information along the way so that they can do their first financial statement under IFRS in 2014, rather than the process of getting to 2014 and realizing you have oh my gosh, we didn't accumulate this information back in 2012. Do I still have access for it? Can I get it? We're really trying to put in preventive measures versus detective measures to make sure the companies can comply with IFRS efficiently and effectively.
Okay, we've got some questions on documentation, then also disclosure. So again, under my multi-element arrangement, I'll throw some in. So you mentioned more documentation to back up the fact that this is more principle-based. Could you give an example of that? And then just kind of add on to that, John, because of this reliance on more professional judgment than GAAP, will there be more disclosure requirements to aid a user in reading of financial statements? So documentation and disclosure.
Definitely. Well, the answer to your second question is most definitely yes. And that's one of the things one of the benefits that the organizations really saw as coming out of this is the fact that it will lead to increased disclosure in the financial statements, which will lead to a better level of comprehension from the reader of those financial statements. It'll encourage companies to disclose more to show that thought process as to why they accounted for items in certain ways. As well, we would expect that sort of thought process would be more likely documented more concretely through the use of memos, within systems, what have you, within the company's financial accounting records. So it's going to require a lot more putting pen to paper and doing even more writing, which I know all of us accountants love to do more writing than we already do.
I'm the only one that can hear me you can hear laughing, I guess. On specific guidance with regard to industries, are there some people have asked about, again, we have people on the webcast from many different industries. Do you expect any industry-specific guidance for IFRS, or is it less industry-specific?
I really, this is my personal opinion. This is based off of what I've read and what I've heard, I really expect there to be a lot less industry-specific guidance coming out of IFRS. Because one of the goals out of IFRS was really to try to simplify the accounting guidance and allow companies to make more informed and not necessarily have latitude, but make decisions and then disclose how they made those decisions in the financial statements. So I believe that there's not a strong desire at the International Accounting Standards Setting Board to come out with a lot of industry-specific guidance.
Okay. Next question. When companies apply IFRS, will they have to provide IFRS-compliant comparatives?
Now, say that again. I didn't quite get that, Bob.
When companies apply IFRS, will they have to provide IFRS-compliant comparatives?
Yeah, yes. Whenever companies are filing their first IFRS statement, they will need to supply IFRS comparative statements for the applicable years, as well as in the first year, supply a reconciliation from IFRS to the prior reports filed under U.S. GAAP.
Switching gears a minute here, John, you talked about training for people. You talked about students and things like that, but for those in the workforce now, they have to get trained. Do you view it as there'll be a CPA-like certification required for U.S. CPAs and CPAs worldwide? How do you see that going, from a professional education, professional development perspective?
That's a great question. I haven't seen anything come out from a certification standpoint from IFRS. I can tell you that they are looking for people to help write IFRS-specific questions for the CPA examination, so they're already starting to think how that examination will change. I haven't seen anything about a particular certification under IFRS. I might have just missed something. But one of the great things about IFRS is you can go out and buy a copy of the standards. I mean, it's a book. It's not a big book. It's a 200 to 300 page book, and somebody can just start to read it and understand it. I mean, heck, for that matter, for free, you can go out to Grant Thornton's website and download a comparative of IFRS to U.S. GAAP as it stands now. It's 160 pages, and that costs nothing, so that can sort of start to already give you some training and background on IFRS. So there's a lot of free resources out there, and you can also start to the extent you're a multinational organization, reach out to your entities that have already complied with this and start to talk to them about the changes and what it costs and what they would do differently if they had to do it all over again.
A little more logistics and timeline question, John. Do you know when the SEC will release the final roadmap, and will it be this quarter or by the end of the calendar year?
I think that is the million-dollar question, and I, as probably everybody on this webcast, wish they knew the answer to that question, because it's sort of if we were in this sort of limbo stage with SOX, companies would be feeling the same thing. I would say this: I don't believe there is a lot of risk for companies to start doing the phase one analytic of how it might impact their organization, to starting to get smart on IFRS and how it might impact, and how that might flow down to changes in information technology, processes, and the like that need to be put in place. That doesn't mean that you necessarily need to take action now, but it gives you some more intelligence, basically a risk assessment as to what the company will need to do.
We, in conjunction with RevenueRecognition.com, recently did a survey on the IASB and FASB Revenue Recognition Project, and that report shows generally positive views on the proposed changes. It does show, of course, some problem areas that will require some tough decisions. We do have some questions on how these intersect in terms of, so specifically someone asked, how does the IFRS and joint FASB and IASB revenue recognition project relate?
Well, all of the one of the key steps along the roadmap, and before the people developed the roadmap, or before the SEC developed the roadmap, was what is still known as convergence, and that is trying to get the international standards and U.S. GAAP closer and closer together. We expect convergence to still be ongoing and continuing, and definitely feeding into the overall IFRS statements as the process moves forward.
A few more questions. As companies try to wiggle around the IFRS principles, do you expect that IFRS will have to become more rules-based?
That's looking into my crystal ball. I think we'll have to take a wait and see to that. I really can't conjecture at this point.
One more crystal ball question. What happens to GAAP?
Well, if history is any indicator, whenever we make this transition to international financial reporting standards, I would anticipate that over time, U.S. GAAP could become less and less a factor, because there's really only so many bodies of accounting knowledge you can have, and as we really start to embrace IFRS, I would imagine that a majority of companies move that way, whether they be private or not.
All right. Well, John, thank you very much. We're a little up against the clock here. We couldn't get to all the questions, but thanks. When you're right in the middle of this, which is of great value to our customers and other people on the webcast today, and we appreciate your insight, your experience, and I have a feeling this is not the last time we'll talk about this. So thanks to our audience as well. Thank you to all our attendees and those people who asked questions. We got hundreds of questions, so we couldn't get to them all. There is certainly a way for you folks to converse on revenuerecognition.com. If you look at your screen now, revenuerecognition.com/forum is a way for people to connect on certain topics and weigh in on certain topics directly with their peers, and not only for this topic, but for many topics as they deal with revenue recognition. So please feel free to do that. It's a very well-traveled area of that site. And please stay tuned to your email, revrec.com. Continue to visit, and softrax.com for future events. And thank you, everyone, for visiting.